Bonjour, ciao, and haribi.
Hola, amigos, desde América Latina para toda nuestra audiencia.
Konnichiwa and hello.
And welcome to episode 2. We rehearsed that, believe it or not. And welcome to episode 2, a Sustainable Strategy Brief Live, where we're going to be talking about sustainable business growth, turning sustainable business growth into a credible business model. But before we get cracking, we're going to run a quick animation, which will give you an outline of what we're talking about today. Okay, well, welcome everybody. We're joined today by Professor Paul Phillips, who's hosting the Sustainable Brief Live. Hello, Paul. And whereabouts in the world are you today?
I'm in Canterbury.
Canterbury, not that far from me. I'm in North London. And Allen Cedeño, and where are you, Alan, today?
Panama.
Panama. Oh, what's the weather like in Panama today?
Oh, it's pretty good now for everybody here.
Okay, I wish it was a bit hotter here. 5 degrees, not too bad. Anyway, today we are talking about turning sustainable growth ambition into credible business cases. And I thought we'd get straight to it with a question. So the traditional approach to sustainability business cases is fundamentally broken. Organizations follow outdated patterns that guarantee rejection or stagnation. Discuss. Paul, can you expand on that statement?
That sounds like a student exam question there, actually, the way you said that.
Well, I'll give you marks when you've finished.
Okay. If I can use a sporting analogy at the moment, I look at it in terms of what I call the old game and the new game. And the old game is very much about compliance and reporting in the sustainability world. We've now moved on into the new game, where it's about connecting our sustainability aspirations into the P&L account. But in such situations, new games require new rules, and new rules require new skill sets. And that is something which this type of show is looking to do. So what we're trying to do is to help organizations exploit their knowledge to better themselves through playing the new game. Thank you.
Okay, same question to you, Alan. Just to remind everybody, the traditional approach to sustainability business cases is fundamentally broken. Organizations follow outdated patterns that guarantee rejection or stagnation. Can you give us some observations about that statement, please?
Sure. Okay. Let me frame this clearly. The traditional approach fails because it is written in compliance language, not capital logic. Boards don't fund narratives; they fund investment. What they expect is a verified baseline, a CFO-grade model, a clear financial KPIs, a pilot with controls. So once you make that shift, sustainability moves from reporting to deployable capital.
Okay, so what does sustainable growth ambition really mean? In today's global business environment? Alan, why don't we'll alternate the order. Alan, what does sustainable growth ambition really mean in today's business environment?
Okay, at its core, it is about translating ambition into measurable financial impact in practice. That means moving EBITDA, reducing risk exposure, or lowering the cost of capital. Then ambition sets the direction. Sustainable growth is when finance can clearly link it to cash flow and decision-grade metrics.
Okay, same question to you, Paul.
I think if we take a strategic perspective on this and look backwards, 6 decades ago, the formation of strategy, we've had 60 decades of looking at applying strategy and creating business plans. The sustainability business cases have tended to ignore this. And right now we've seen as a pivot whereby we've now got to apply the strategic aspects into sustainable business cases. So what we're looking for is that these cases, they need to be now credible, quantifiable, and visibly linked to future cash flows, which is the B end and end of everything. So it's really looking for, the board and investors are looking for this term equity theme, equity story, which actually talks about the data-backed narrative. Yeah.
Okay, so I think you kind of asked the next question really, which is when the board's investment committee asks for credible business cases, what are they really asking for? I think you've kind of answered that to an extent, Paul, but maybe you can expand upon that. But I'll let Alan go first. But
I can expand it. I can expand it for sure. If we talk about a couple of words, one of them would be governance, say, for example. We're looking at the governance in the strategic and tactical levels. At the strategic level, we're looking at things like what is the value proposition of what's being put forward, the value pool, where's all these profits in terms of, what we're going to tap into. And we can also talk about the scope. What is the scope of the business? And it has to be something we keep recurringly saying will be evidence-based. At a tactical level, what we're going to be looking at, just very briefly, is looking at inputs and outputs, throughputs, and making sure that processes are measurable and traceable, such in supply chains, and they stand up to scrutiny. Thank you, Michael.
Okay, thank you, Paul. And same question to you, Alan. Let's just make sure I've got the right screen up. There's a lot of buttons that I'm pressing. When the board and the investment committee ask for credible business cases, what are they actually asking for?
Okay, so I'm going to be a little more pragmatic. They are asking for three things. First, a verified baseline. Second, a CFO grade model with low, central, and high scenarios and clear sensitivities. Third, explicit grade criteria. Approve, scale, or stop. And no storytelling, just assumptions, numbers, and decision points. That's what they expect. That's it.
Okay, thank you for that. So is it kind of about, is it really just about revenue and resilience, or is it more about reputation?
Yeah, okay. I think it depends on the value proposition again of the organization, the institution, because it impacts the positioning on the product or the industry life cycle, because these will then impact the focus of the strategy. Interesting enough, what I noticed just last week in reading a little article, it was basically saying for 2026 in sustainability speak, the number one priority is cost reductions. That is what's driving these things. But as we know from strategy, adopting a cost leadership strategy, you have to be very, 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 very careful. And that then ties into this show in terms of you must make sure that your finances are correct, that they're operating in the right way. And then I'm just throwing one more thing about the marketing metrics as well. If we're talking about what you mentioned, the reputation, the marketing metrics around greenwashing and stuff like that are now very, very crucial and important because organizations continue to be caught out.
Okay, thank you, Paul. Okay, Alan, do you want to answer that question?
Yeah. Okay. To be honest, for me, it is whichever move the economics. Boards decide on margin, cash, risk reduction, and cost of capital. That's in my experience. Reputation only matters when it directly affects revenue or financing. Reputation alone rarely clears the CFO threshold. That's what I can say about it.
Okay, so Alan, by a miracle, if Lady Luck is shining upon us in a moment, the question I'm about to ask is going to magically appear on the screen. But Alan, you think most sustainability business cases fail before they even start? Pray, why do you think that?
Yes, they fail at first contact. Capital is requested without causation or measurement. So without a baseline, as I said before, without a baseline, attribution and delivery cadence, proposals stall or get stuck in explore mode indefinitely.
Okay. And Paul, so why do you think sustainability business cases fail before they even start?
If I can use the analogy of a book writing a story, they should have three parts: a beginning, middle, and end. The beginning should really be, getting you interested into the actual the story to be told. So there's the things that I use, the 3 C's. They need to be credible, concise, and they need to be compelling. Because at the end of the day, people have to read these business cases. Want to make sure they do tell a story. And I think the other thing Alan's alluded to is that's very important is that we have these aspirations, we have these initiatives, but they now have to be connected to the P&L account. There needs to be like a bridge to connect. And I think that's really makes a good story if we can see those clear connections.
Okay, so you're not a big fan of the Quentin Tarantino approach to telling a story. He seems to start in the middle, then move on to the end, and then finish with the beginning. You like to do it the traditional way.
Netflix style, isn't it?
Yeah, right.
Indeed, yeah. Okay, so what does a good sustainability story, what turns a good sustainability story, I just talk about stories, into a truly investment grade business case? Paul.
Well, I think if we just dwell on what I've just been saying is that the story has to be evidence in fact, not fiction. We can keep the bit going through. And when we say fact, we mean fact that is held by the CFO and the board because they are accountable to external stakeholders. What we do notice in business cases is that there may not be a clarity of thought. There may not be an understanding of the market that they're in, because now what we are seeing is that there is no clear market boundaries. There's, the world is global, yet the markets are now seamless. And I think the business case story has to be very evidence in fact. And one of my colleagues used to say to me whenever we put something together in a project, he said, well, who cares about this? Who really cares about this? I think that is something that is a test of when you are looking at these stories and these narratives.
Okay, thank you very much. So I'm sorry, for some strange reason, we're getting a lot of comments and people's names aren't mentioned. I cannot begin to give you an explanation as to why that is so. But thank you, Anita. I know Anita. Anita's been a guest on shows that I've organised before. For signing your comment, and glad to see you're watching it. Alan, same question to you. So what turns a good sustainability story into a truly investment grade business case?
Okay, so more than talk about turns a good sustainability story into an investment-grade business case, I would like to give you evidence. Okay, so a verified baseline, a pilot with control design, a full NPV and IRR model. Okay, what's that? An NPV being the net value created, and IRR the return generated by the capital invested, and of course, sensitivity analysis. And one-page cupcake that force monthly decisions. So, in short, proof, not promise. That's what you need.
Okay. Proof, not promise. The proof of the pudding is in the eating, I think is probably another way of saying that. Okay. So, our next question. It's about leaking value. Where do most sustainability business cases leak value today? Alan, I'll stick with you. I think I want to keep giving Paul the first go. So where do most sustainability business cases leak value today, do you think?
Okay, me, say?
Yes, please. Yes.
Okay. Typically, 3 areas. Unverified assumptions that overstate savings, lack of attribution, so causes can be isolated, and weak governance with no clear 30, 60, or 90 days delivery discipline. So that's where expected value quietly disappears. That's the leak.
Okay. So someone said, Michael, I think your point about reputation needs to be explored. In fairness, I think I should point out it wasn't my point, but so I suppose reputation and P&L and resilience, they are related, but reputation is more of a long-term thing. You know, if you've got a good reputation, then in the long term, that's going to boost profits, I suppose. So the credible business cases, can we explore just a little bit about how that relates to reputation? Any thoughts about that?
Who's this for, Michael?
It's for whoever wants to answer it, Paul.
Okay.
I'll just jump in and say a few things. I'd say that reputation is very important, but what it can boil down to is looking at marketing metrics, for example, and these marketing metrics have to end up in the P&L account. So if I can just take an example of perceptions of brand of greenwashing, say for example, somebody would have done some form of market research to assess this capability of greenwashing. And what we have to do is to convert that into a risk, and then convert that into a risk which says, well, if this was to happen, how is that impacting our revenues? And then these net revenues will then, the adjusted EAL, will then end up into the P&L account for the revenue line. So basically everything has to be costed. Now, the problem is some of these processes are qualitative, and we are talking about applying numbers to them. So I can see what that person might ask that question, but that's what we got to do. Thank you.
I'm kind of thinking of the 3 R's here. So I mean, traditionally the 3 R's means writing arithmetic and I can't remember what the other one is now. And people will now ask me, they say, what's the secret to journalism? And I say it's the 3 R's: research, research, and research. But I think what you're saying, it's resilience, it's reputation, and it's risk. Alan, what are any thoughts about this the reputation? How reputation ties into the issue of credible business models?
Okay, so let's see, what is reputation, first of all? And reputation is when you show what you what people expect you are. But that's not the magic of what you have to do. Decision grade ESG data is operational and directly linked to the P&L. Then things like real energy consumption, costs actually avoided, and revenue you can genuinely attribute. So now is aggregated reporting data with no baselines and not clear causal link to cash flow. So when you take all those things and you do that and you eliminate the noise, your reputation get better because you are doing the right things. So you have to be pragmatic in that way. You have to be careful what you say that you are doing in ESG in your company. So you gotta be conscious about that you are making something not just for the society, not just for the climate, but just for your company and for the ESG together. That's a good reputation plan.
All right, thank you for that. And thank you, Jeff. You're right. It's reading, writing, arithmetic. Reading was the word that escaped me. And I think your reputation would soon be shot if you started really spelling arithmetic and writing with an R. But okay, so next question, which hopefully, where do most sustainability business cases leak value today? We haven't answered that question yet, have we? I don't think we have. Where do most sustainability business cases leak value today, do you think?
Okay. I can jump out. Well, okay. Where they leak value, that reminds me of our previous episodes when we had the plumbing analogy. And I quite like that graphic, looking for the leaks. I would just say, which is the strategy, compliance for breakfast. I would just say two words, business models. I think the business model is very, very important in this because the business model is kind of like the backbone of the organization, and the bits around it. For example, the customer needs are very important. We just touched upon reputational, and then the other number one important thing is supply chains. They are very important in terms of where there are leaks to be solved, and organizations have become very sophisticated in dealing in the global supplies and supply chain literature. And I'll just frame one more, the KPIs, when we're talking about are there too many KPIs? Are there the right KPIs? Qualitative, quantitative measurement, these are all things that are challenging. Collectively, these all form leaks to the ESG sustainability strategy. Michael, thank you.
Okay, thank you, Paul. And thank you for the tip for the book, Belinda. I'm wondering, is that a book by you? I don't have enough time to look it up when we're broadcasting live, but thank you for that tip. Yeah. Alan, same question for you.
Okay. Do you repeat the question, please, again?
Yes, of course I can.
Sorry about
That's
that.
All right, I'll call it up for you. It's about leaking value. Where do most sustainability business cases leak value today?
Okay. Okay, I guess I'm probably with the mic again. You said revenue?
Oh, I'll call the question up for you. Hold on.
Yeah.
Where do most sustainability business cases leak value today?
Oh, okay. Okay. Okay, give me a second. So, okay, I think one of the typical areas where the business case leak value today is unverified assumptions that overstage savings, lack of attribution. So cases can be isolated, and weak governance with clear 30 or 60, 90 days delivery discipline, as I said before, that's where expected value quietly disappear. And I insist. So when you are or you have a project for the committee, you have to get all these things together so you can prove that your project is is a real value to your company. That's what I think.
Okay, all right. So moving on. There's a lot of questions we're going through this pretty quickly, really. What ESG data actually changes decisions, and what's just noise? So this is a question about noise versus actual meaningful data that changes decisions. Paul, thoughts on this question?
Okay, I'll just give a holistic response because it can get very detailed and we don't have that much time. But I would say that it depends on the strategic philosophy of the organization. And what I mean is that you get an organization that is very much led by marketing, say, for example. I'm talking about the Marsden's topology, say, for example. So you can have like a prospectus type organizations, first to the market, spend a lot of money on market research, highly innovative with its products and services. So that type of organizations, they need to ensure that the ESG data, the money that they spend on their ESG data, aligns with what their strategy requires in the marketing side. Conversely, you could have another organization, which is more like an adaptation of Masters Know, which is more financially driven, and their ESG data has to be focused more on the numbers, and perhaps more importantly, Alan mentioned, attribution of the data, making sure that it's fit for purpose and it doesn't include any elements of double counting, say, for example. That's it.
Okay. All right, thanks for that. Look, we are, as ever, pushing the clock quite hard. What I like to do now, Alan, is rather than ask you to ask that question, we'll move on to the next question. I'll ask you to answer that one. And then the next question after that would be back to the two of you in an attempt to try and catch up. Mm-hmm. So, Alan, can you share one case example where a sustainable strategy clearly drove revenue? So can you think of an example of this?
Okay. Okay, a brief example. We pilot an eco-design product line with controlled rollout. Attribution showed incremental sales and roughly an 8% margin, I remember, uplift from premium pricing and higher retention. So that pilot data justified CapEx scale within 18 months. That's what's real, and that was very, very nice for the company. And that's what people have to do.
Okay, thank you for that. Now, Alan, this is something you said to me, but I like both your take on this. Sustainable ambition is necessary, but it's insufficient. To be effective, it must be constructed as an investment case with four negotiable elements. So my question for both of you really is, what are these four key elements? And Alan, if you can remember all four of them, I'll ask you to go first, and then Paul, I'll ask you to comment, if that's okay.
Okay.
So the four elements, Alan.
Okay. Okay. Keep it pragmatic. That's my baseline all the time. Think a 30 days block. In the first 30 days, verify the baseline and align the three financial KPIs with an executive sponsor. By day 60, like the CFO gray model and the pilot with clear controls. By the day 90, go live with a pilot and use a one-page cupcake to drive decisions. That's what I can say about put together all the things in that way.
Okay, and comments, Paul?
I'm conscious of time. I would say the baseline is very important. I know from experience when I've looked at institutions' data around this, and actually their baseline is not a baseline. So we have to go back to the beginning and recalibrate that. That is, so what Alan point is very, very important with the right KPI. And then this 30, 60, 90 is very important in two areas, actually. One's about control. We want to make sure that whenever the organization is left to get on with it, it just doesn't stop and collapse and fail. So there needs to be something to do in the 30, 60, 90s to maintain momentum. And there needs to be clear controls for the organization that we can see when we're doing the analysis, to make sure that when we create the cockpits, as they call it, that everything is bubbling along and working nicely. And we know that we're not as scared to say stop, halt, into projects. You know, we've got too many projects, don't be as afraid to kill some of them. So I think the elements are very much around, you know, decision making, verification of where you are, and knowing where you are on a transition on your journey, because everybody's on a journey. Knowing where you are, I think, is very important to chart the path and the roadmap.
All right, thank you for that. So we are running out of time now. We are due to finish in 3 minutes' time. I've got 2 questions left. So what I'm going to propose to do is I'm going to show both those questions, and I'll ask one of you to answer one question and the other one of you to answer the other question, and you can fight over who's going to ask which question. So we've got, if we consider the financial core, what 3 numbers would the CFO expect to see to show how key assumptions affect outcomes? And the other question has disappeared, but I know what it is. It's the one about 90 days. I think we should have answered this one earlier, and it's completely vanished from my schedule. So what I'll do, thinking quick, I'll ask you both to have a quick answer of this question whilst I try and recall what the question was about 90 days. So over to you, Paul. Would you like to go first?
Okay, I think I'll hand it over to Alan, because Alan has spoken to me about it, and he's very eloquent in the phrase. Right. I don't want to steal his thunder. I'll let him say the phrase. In your
capable hands, Alan.
Alan, you're...
Okay, so, okay, absolutely. Okay, the core message is discipline, okay? Sustainable growth only becomes real when ambition is treated as investment decision. So that means verifying the baseline once again, piloting with attribution, modeling with CFO level rigor, and governing execution through a simple calculus and clear gate. Then, when sustainability moves cost, revenue, risk, or cost of capital, it earned a seat at the capital allocation table. Everything else is aspiration, no strategy. And that's what they want to hear. That's what they expect.
Okay. All right. Look, we're due to be finishing in a minute.
Yeah.
I think we can go over by a couple of minutes, but I don't want to go over by more than that. But I have found my question, which I've now lost. Paul, would you like to summarize some key points here? Can you just give us the quick summary of the important take-home points from this discussion today?
I would like to say, firstly, thank you for all the comments. Alan and I haven't had time to look at them because we've been busy talking. So we're going to get back to the comments. So that's one thing I like to stress, very important. It'd be nice to see what's being said and interpret them. But I would say the main takeaway is I was just reading up just recently about the amount of money that countries and regions need to get back on a sustainability path. And we're talking about fundings going into the trillion of US dollars. And in many cases, they say that it's not enough. So what I put it to everybody is that business cases are being written by everybody around the globe, from small sums to very large sums. And I think the main thing is we need the partnership between those people who are the evangelists of sustainability. You know, when we go back to the 1960s and that sort of thing, very much about their views. Their views have to be translated into today's business views, which unfortunately is around finance and is around strategy. So we're not saying that numbers are a bad thing. They are a necessary thing for people to get their business cases funded. I think that's the big takeaway for me. And what Alan and I have tried to do to show some of the common issues, but we haven't touched this because it's a huge area. But I think it's coming together that ambitions need to translate ultimately to cash flows, because the people who provide these finances, they have quite sophisticated ways of assessing the business case. The banks are very clever with this. I mean, just saying to play that game is necessary. And I've been involved in this personally. You've got to play the game of the bank to get these funds and these things. That's what I'd like to say.
Okay. Yeah. So Alan and Paul will be answering your question. The questions that are on LinkedIn, Alan and Paul will be answering them. Alan, rather than asking you to summarize, I have found that mysterious question that I couldn't find earlier. I don't think we've asked it yet. For leaders stuck between ESG fatigue and ambition, what should they do in the next 90 days? So you've got 45 seconds to talk about the next 90 days. So what should they do in the next 90 days, do you think?
Okay, it's a good question. After the 90 days, you have to go back to the block of 60 days. Okay, why? Because once you measure your baseline, your attributes, and your capital control, so you have to keep monitoring everything, but at least 6 months, because the CFO is going to call you and tell you, hey, what's going on? You promise this cost will be lower or this revenue will be higher, but I can see that. So you have to be monitoring your formula, your presentation, what you did, and then be careful after the 90 days on what you monitor is doing. So please try to be near to the reality, not just the narrative. That's storytelling. You need to be clear about your project in numbers, EBITDA. You need to be clear about cost and paybacks to the company. That's it.
All right, thank you, Alan. And Paul, I'd like to give you the last words. You'd like to have a bit of a call to action here. So what's your call to action then? And then we must
finish. The call to action, just very, very simply, is what we're going to try to do with this is if you can drop case in the comments, we will be putting together a couple of documents around this, which ultimately can use as checklists, so you can sort of get to grips with what we've been saying. So that's something we can do. If you forget, or if you want to be very free to message me on LinkedIn, and I can ensure that something gets sent to you. So it's just to let you know there is a call to action. We'll be working on 2 documents, which will evolve into checklists on what we spoke about. Obviously, this is just the beginning of our journey, and I'm very grateful for all the in-depth comments that have been added, and I'll be busy reading some of these things the next couple of days. So just bear with us, and thank you for joining the show.
Well, thank you very much, everybody. Thank you for your comments, and amazing comments today, which Alan and Paul, and who knows, maybe me, will endeavour to answer. And thank you very much for watching. And for me, Alan and Paul, goodbye. Or au revoir, I should say.
Thank you very much for your time, guys.
Thank you. Bye.
Bye.